What's going on, guys? We got an important video for you guys here today. Probably one of the most important concepts in the market. You guys in the academy and you guys that follow me know me for trading gold and trading crypto. It doesn't really matter what market or instrument you're mainly focused on, whether that's the currency pairs or whether that's indices or the crypto market, or like me, my main focus is just gold. You got to understand market structure. So in this video, we're gonna be doing a lesson on understanding market structure and what it is, as I think market structure is pretty much the skeleton to the market. If you can really understand market structure, you'll be good in your trading, because trading is really about identifying trends. I like to say it's about going with the flow. So your goal as a trader is to identify the flow. What is the flow of the market? Because trends can last for periods of time. You could have trends that could last for 30 days in a bullish uptrend or a bearish downtrend. So you have to understand the market doesn't move necessarily in a straight line when it comes to uptrend and downtrend in the market. When it comes to market structure just refers to trend analysis and identification of a market trend, whether that's an uptrend or a downtrend. So it refers to the way price movements form over time, showing how prices are changing in reaction to highs and lows. In the case of an uptrend, we have higher highs and higher lows. So this is what an uptrend is. An uptrend classifies itself as a market that's consistently making higher highs and higher lows. A downtrend is the opposite of that. If you look here, we have an example of gold making an uptrend over a period of time. A trend can last for a week, a trend can last for 2 weeks, a trend can last for a month, a trend can last longer than that. It really depends on the time frame you're mainly looking at, because if I'm looking at a 5-minute chart, a trend could last in the session that I'm looking at, like London session, let's say, for instance. For those of you guys that are familiar with the London session trend, London session can often trend into New York. So if I'm looking at a 5-minute chart, there could be a trend on the 5-minute there. If I'm looking at a 4-hour chart, like the chart we have in front of us, it's spread out through a period of time. For example, this is May until basically the end of May. You can see pretty much the whole month of May here was in an uptrend, making higher highs and higher lows, maintaining a market structure. Typically when the market makes a higher high, that's where resistance comes in. Typically when the market's searching for a higher low, that's a retracement, and that's where like a support comes in. So higher highs and higher lows can be places of support and resistance. I have a good higher high strategy on selling the market. Typically when the market makes a higher high, I know I'm looking for sells in that structure, especially if it's on like a 4-hour chart like this. So what is a downtrend? Downtrend is the exact opposite of the chart that I just showed you. It would be the exact opposite sequence. The market's going to be making lower lows and lower highs. This can be identified on any time frame. So style is important, because if I'm more of like a scalper or a day trader, someone who's more focused on a 5-minute or a 15-minute chart, I have to get good at identifying structure in that moment and what's in front of me. Structure is really key to identify through different variables of time frames, through the different intervals of time frames, because a structure can tell you what's happening in the moment, especially if you're on a smaller time frame. If you're looking at a larger time frame, it could show you how the trend is for a longer period of time. Example here is a downtrend, exact opposite of what we just looked at in the uptrend in May. If you saw May this year, gold went up for like 30 days. If you look at August here, we have a downtrend on the 4-hour chart. What is the market doing here? It's making a high, and that high is turning into a lower low, lower high, lower low, lower high, lower low. So when we're going to the chart really at any point here, we're looking back to tell us where the market is. We're looking kind of behind us, right, to get an idea of where the trend overall is. Because when you're looking at the sequence here, there's big bullish moves here. There's these big bullish moves, but those are just taking you down more. So any trader who was looking for buys would have been fine, but they had to know where they were really trading here in the structure. There's no reversals happening here. until the market starts to shift over here, which we're going to talk about in another video in conclusion to this video, part number 2. You guys want to watch part number 2 after this, where we talk about break of structure, okay? This video, we're going to be talking about market structure mainly, the importance of understanding impulsive moves and corrective moves, because the market doesn't just move in a straight line. Doesn't matter what time frame you're looking at, a 5-minute, a 30-minute, or a 4-hour. Depending on the time frame you're looking at is going to be more arrived on the style that you approach the market with, right? Structures can be seen on any time frame, and naturally over time, you might get good at being a trader who identifies them really well on a 5-minute chart. You might be someone who's maybe a little bit more conservative and likes to be laid back. Maybe your structure is better to identify in a 4-hour. But you have to understand impulsive and corrective moves, because the market doesn't just move in a straight line. It moves within something called the Dow theory, right? So this is impulsive movements and corrective movements. When we get an impulsive move, typically a resistance is found, because an impulsive move means demand was greater than the supply. So when demand becomes greater than supply, we're typically going up. Shortly after that is a period where maybe greed comes into the market and people are buying at overbought or overvalued levels, and price will correct, aka reverse. So these are the two types of movements you really want to focus on. Trends can be categorized by these types of movements. Let's move forward a little bit and talk about just the key components of your market structure. Number 1 is higher highs and higher lows. Each peak in price is higher than the previous when we're talking about higher highs and higher lows. So we call it a through. When we go back to the line chart, when we go through a previous high, through it, that's what we call it. We're looking at these as throughs, going through a previous point, all right? So this indicates an uptrend showing bullish market behavior. We have to know kind of where we are and price, where we came from. Where did price come from? That's what market structure can help you identify. Another thing we're going to talk about is consolidation and ranges, but here is another little cheat sheet for you guys on higher highs and higher lows. Whatever time frame you're looking at, you want to study this. The market will not just move in a straight line. And we're going to go to the charts in a minute here, and I'm going to show you guys a lot more on understanding trends and how they can last for periods of time. We're going to take it up a notch a little bit here. But what you want to understand about the market is it's categorized in phases. We don't just move in straight lines. The market can move in phases, which can tell us where we are or where we even came from, can help us identify where we can go next. So you have your uptrend and your downtrend, which we just talked about. But another phase that's really important to recognize is the sideways and range. This is characterized by equal highs and equal lows, like a support and like a resistance. This can be known also as accumulation or distribution. Very familiar concepts in the market that you're going to want to learn when it comes to market structure and price action. So remember, write that down when it comes to sideways ranges, accumulation and distribution. Study that as well when it comes to market structure. What a sideways trend can really identify for us is that the market could be shifting. It can be easy to trade in a sideways market like a support and resistance. You can find a lot of buys and sells in a sideways market, but it can also mean that the market is shifting from an uptrend to a downtrend. So when it comes down to market phases and trends, this is a part of it. The market doesn't go up forever and the market doesn't go down forever. It's not going to be in an uptrend forever. It's not going to be in a downtrend forever. So when the market starts to gauge more sideways, it can start to tell us that the trend is potentially shifting over when it comes to structure. If you look at this trend here, the market's going in an uptrend, making higher highs and higher lows. That stops here after we swing down and we make this low. The market fails to make a higher high here. It actually makes an equal resistance. So we start trading in this range, and eventually we break out of the range and we go in a downtrend. And we start shifting from higher highs, higher lows, to downtrend, lower highs and lower lows. Let's go over the chart and make a little bit more sense of some things real quick. We're on a 4-hour time frame with gold here. And I put a little indicator on just to help you guys see some of the swing points. Higher highs, higher lows, or lower highs and lower lows. If we look at the chart here, for instance, there's low points and high points that the market's gonna form. So these are structure points, right? You can see the prices are marked already here. These are structure points, these are swing points. Now, the market can trend for periods of time. If we mark the months, it's important to focus on like the monthly open and closing, because if we look at months, there's periods of time where the market can literally trend in one direction. Let's take a look at this chart, for instance. What I'm doing is I'm marking some lines right now at some of the starting points. What I'm doing right now is marking the beginning of the months. I marked June here, I marked July, August. I'm gonna do some more actually, just to see if we have some more examples of this. Let's go back to like the beginning of this year that we're looking at here. I think we're in the 2023. So let's go look at this. And there's a lot of other things we can tie in together, but I wanna keep it basic here. We're not tying everything in together. We're just talking about one concept here, trending market structure, right? If we look at months, if we look at January, for instance, January is known as a time where gold can tend to be bullish. January went up until February. When you look at price on a 4-hour point of view here, what did price do the entire month from the beginning of the month to the end of the month? What could you say about price? It was in an uptrending direction, okay? Let's go to the next month. What could you say about the next month? I think you guys already got the answer. You could say the next month was in a downtrend. So when you view price on a broader point of view, right? Because a lot of times we might go to the charts and be like, what is happening right now? What is price doing right now? We can sometimes take a step back. We can get a bigger view of price and where it's going, what trend it's in. Because if we look at month by month on the market, we can have months where the market goes in an uptrend. We can have months where the market goes in a downtrend. So if we look at here, gold went from 1825 at the beginning of January. At the end of January, on February 1st, price was at 1955. So that's over $100 increase. If you know gold, that's a really big increase. If we look at February started up here. We went from 1955 way down to 1805, around 1800 lows. So the whole month trended bearish. If we continue this and look at the next month, the following month is March. What was March? March was a bullish month. So if you're looking to swing the market, right? A lot of traders are trying to swing the market, but they go to the market every day and they put a 500 pip trade, a 500 pip trade. Maybe they're not taking a step back and understanding what the bigger picture of the market is, or the fact that the market could go in one direction for a long period of time. So when it comes to looking for trends, it's understanding the market can trend in a long direction, and it's getting a sense of where there's market structure inside of there. Maybe it's not catching the bottom or the top of the trend. We're probably not gonna catch the exact bottom of the trend or maybe the opening of the month, but if we follow structure in here, you can see there's some good swing points along the way that the market's creating. Let me change the color here so it stands out a bit more for us. Let's go to yellow. So if we look here, we can see the market had an uptrend the entire month, 30 days up. We don't have to catch the bottom of the trend. Remember what I said at the beginning of the video when we were on the PowerPoint? I said, it's about going with the flow. So you want to identify the flow. I've said that in other videos too on this YouTube. You don't have to catch the beginning of the trend. You can look for the piece of the trend that's inside of it, those waves. You don't have to catch the bottom or the beginning of the trend. You can catch the inner part of the trend. Because if you look at here, there's a lot of structure points that sort of tell us the market is flowing upside. We can see some higher highs being created. All the way here, we have a high, we have a low. What happens from that low? The market pushes up, it goes through, remember, through the previous high. And now we've formed a breakout point in structure. We've broken out of this high, and now we're basically exceeding that demand or that supply. Remember what I was saying before, supply and demand exceeds supply there. Where there was sell pressure, turned into buy pressure. So now we form a support off of that. And you can see as the market goes, it's forming higher highs here. So these pullbacks are really just retracements in your structure to continue higher in the market. If we go to the downtrend, you have a very similar concept. Right? The market moved very bearish from here. And this is February. The market went down from the beginning of February to the end of February. So if we go back to our slides, we have a downtrend here. If we look at the structure and price, right? The market is starting from here. and it's finishing all the way down here. Inside of there, there's different waves that create lower lows or go through the lower lows, right? Like right here, price makes a nice lower low in structure. And what does it do? A breakout and retest, continuing the trend. Maybe if we tie whole numbers in there, market timing, candlesticks, we can see some other things. The market continues making lower lows in this structure until we actually break out over here and we start to shift the structure and we start making higher highs over here. So you can see at a point throughout all this trend, there's a point where I could have joined the trend, AKA go with the flow. If we go over to the following month, March, what did March do? Same thing, uptrend all month. At some point, I'm gonna be looking at this trend like, what is the market doing? Is it making lower lows? Is it making higher highs? What do we see here? We can see the market is making higher highs in structure and continuously making higher highs and higher lows. If we put a pivots indicator on, so a useful tool on TradingView you can look up is pivots, higher high or higher low, or swing high, swing low indicator. What it does is it marks some of the key swing high and swing low points. So you can actually see some of the key structure points marked here as well that are going with that structure. Month by month, if you were to take the chart month by month and look at, is it a downtrend or uptrend that month? That's kind of what I like to do and what I did a lot of time in my back testing in early studying days. I would take the months and say, okay, is this a downtrend or an uptrend? Clearly, that was a downtrending month. What was the next month? Clearly, the next month was an uptrending month. So when it comes to studying trends, I would take a bigger piece like the month and mark it like this sort of. Because if I go here on this chart, I'll show you guys one last time here. Let's go, this is June, or yeah, it's the beginning of June. So we have the end of June. What I like to do when it comes to studying trends, because a trend's something that's gonna last a period of time, right? A longer period of time, is I would study longer periods of time, something like this, month by month. What was this month? A downtrend. What was this month? An uptrend. Another thing I would tie to that I teach you guys in the academy is seasonality. For those of you guys that know what seasonality is, that's another topic that we talk about inside of our academy. Typically there's months where there's seasonality in the market. Months where the market may be more bullish or months where the market may be more bearish on average. So that's one thing we also like to pay attention to. October, extremely bullish month here. So I like to study the flow of month. This video should help you guys understand market structure a lot more. Make sure you guys watch part 2 of this video because we're gonna take it a step forward and continue this lesson and talk about break of structure. If you guys enjoyed this video, remember to subscribe, leave a comment down below if you guys have any questions. I'll see you guys on part 2.